Super. So thank you very much. So to reintroduce myself, my name is Damba Tonja. I'm originally from half French, half Mauritania, in between. And as I said before, I used to work for Proparco, so I know this room very well. Working mostly within the financial sector, financing banks. And I used to also work at Agence Française de Développement, which is still within the same group at the treasury level. So today I will say my role is a kind of being in between. I always summarize my previous job as when at my time at AVD, I was saying I was looking for money because I was issuing bonds. And when I shifted to Proparco, I was spending that money that I have initially borrowed from the market. But now I'm working at TCX as a vice president within the structuring team. And I will give you a bit more details about what we do. And the presentation, I think we have 53 minutes now, right? And will be divided in, let's say, 4 main blocks. The first one will be just naturally to introduce TCX, what we do, who we are, etc., where we operate. The second block will be dedicated and most importantly to the currency risk, but also the interest rate risk associated to some of our activities across the globe. And with a small small deviation when I talk about currency risk, which is a kind of general words, but if you go into the details, there are too many, let's say, sub-risk. I will tackle the transfer and convertibility risk that sometimes some lenders or borrowers could face in developing markets. And last but not least, the last part of the presentation will be a kind of announcement to what we just announced last week in Sevilla. So just stay with me. So it's a teaser here. So just to start with the first part of the presentation, for those who don't know what is TCX, so we are a fund that has been created 18 years ago. So we are still a teenager, I would say, compared to others MDBs. But the really important thing to keep in mind in our journey is very simple. Our purpose in life at TCX is very basic and simple. If you want to take to keep in mind, the single word here is currency risk. So we have been created to take the FX risk that sometimes borrowers, lenders, or developers cannot or do not want to take. And the way we do that, it's very, very basic. We deal with, I would say basic, but it depends on your background, but we deal with derivative products. So it's mostly swaps and forward. I'm sure if you talk to your colleagues within the treasury, they know very well what I'm talking here about. But we will not go into too much details in terms of technicalities. But the whole idea of this presentation is to just to shed some light on how to mitigate that big risk that has been mentioned by Laurent in his presentation. So the fund, it's really important to know that who are behind the fund. I was just speaking with Stefan from KfW. Thank you. You are one of our shareholders, one of the biggest one. But I need also to thank our colleagues from AFD that are also supporting TCX. So you can, and I see also people from DBSA. So thank you very much for being a capital provider of the fund. And you will recognize also a lot of other institutions that are all active within the developing market. So all those organizations have created TCX, as I said, 18 years ago. Today, the capital of the fund is around 1.5 billion US dollar. And we use that capital to take the risk I mentioned earlier, which is the currency risk, on a different business model. It's not one-to-one, but if I have $1.5 of capital, I can leverage it. And today we have around 10 billion of outstanding loan denominated in local currency or hedges. And last but not least, also we have all the support from some government. You will see all the flags here. So you have the KfW, but you have the German, you have the France, and so on, that are supporting TCX. And I have decided to put some names here. Those are not shareholders, but there are some partners, I will say, call them. AFDB used to be a shareholder of TCX. They exited, but for some specific reason. But just to tell you that they are in the process to be back. Where we operate is, you will see, we just follow simply the OECD dark list. So we can provide the hedge to all the all the countries that can receive development aid. And you can see it clearly. More than 100 countries that represent 95. Why this difference is because some countries, they share the same currency, like the XOF, the CFA franc region. So why local currency funding is important? I will start with one slide. This one, just to take some, let's say, some step back, to look at the data from the last 200 centuries. And you can clearly see in this slide that currency depreciation seems to be something normal. Every year, I'm sure, when you look at the newspapers in the countries where you operate or where you are based, even though here in Europe you see the dollar and the euro moving, or you see the Kenyan shilling moving to stay in Africa, or you see the Sri Lanka rupee moving also. So it's something really, I will say, natural. Most of the, if you look at the statistic, the data, in average, you have more than 15 countries that depreciate more than 15%. If I just look at the average with this orange line. So what I'm trying to share here with those slides is this something you see every day in your business, but also in your life. You can see in the news, in the newspapers that the currency are moving every day. So what does it mean in terms of impact? Of course, if you see those market data moving every day, so it means sometimes it can have impact somewhere in the business or the project you are financing. I wanted just to, this is still a refresher here, but I think it's really important to start with the basic. I just decided to focus, and apologize again in advance to talk a lot about Africa because I cover that region, but the fund, as you know, is operating across the globe. So I have more expertise across the region, but just bear with me when I use a lot of examples in Africa, but I'm sure we can expand it elsewhere. Of course, and not each country is similar to the others, but I wanted just to take a kind of standard view on the currency. Let's maybe use Nigeria, which is the last line you can see here. During the last 10 years, for those who have operated in Nigeria, currency risk has been mentioned every day. I'm sure those who finance project there will say, okay, I want to finance this project, but I keep hearing that currency is a big risk. And again, you can use this example in others markets, depending on the currency regime, but it's a good example here. I wanted to show here 2 points of view. If I am a borrower, I receive funding from, let's say, Agence Française de Développement, to give you some marketing exercise spotlight here. And you provide to them a loan in dollar, let's say $1. 10 years ago, $1 equal 150 naira, 150. 10 years later is 10 times. Today, the naira trade at 1,500. So if I am the borrower, and let's say I'm a developer project in Nigeria, what does it mean if I have borrowed in dollar, keeping in mind that my business model is not suitable to take a loan in dollar because I generate revenue in local currency, the tariff of the electricity is in local currency, etc. So it means I need to pay 10 times more my debt. And as we know, the risk is not disappearing, it's shifting. So someone is taking the risk. Maybe it could be the government, maybe it could be the developer, could be the sponsor and so on, or maybe the lender, let's see. But what I really wanted to show here is, you see 10 times more expensive to redeem that loan. So it means 1,000% increase. You just imagine in terms of inflation, the impact of it can have on your tariff. And if I now change the perspective, I move from the borrower to the lender. Actually, I should stay there because here is the here's the borrower. I will say it. You see 800, close to 10,000. But for the lender, from a lender perspective, if I have invested the same dollar, 10 years later, I'm not losing 10 times. I invested $1, but I lost 90%. So my initial dollar I invested in Nigeria now worth 10 cents. So I just wanted to start with this perspective. When we talk about local currency, it's always good to have those two perspectives. Of course, depending on where you stand, I see many lenders here because mostly DFIs, but it's also important to be on the borrower side to see the impact that the loan you are providing to them will have on their business model. So it means concretely inflation if the risk is not properly managed. So this is quite, I will say, straightforward and a no-brainer. At TCX, what we always say is each project that generates revenues in local currency should be financed in local currency. It's just a basic. You are bankers. If you do your asset and liability management, you match asset and liabilities. Most of you get funding from the market in dollars and euros. So it means if you want to invest those euros or dollars, they need to be in the same currency. Sometimes you do that in local currency, and then this is where you need to hedge. So it's also very important to understand where you stand, and that's why I asked that question at the beginning. Are you a lender? Are you a borrower? Or sometimes the both, the two of them? Because I see, for example, DBSA is one of them. Sometimes you borrow from those institutions, sometimes you all lend on the ground. AFD is a borrower, KfW is a borrower, and sorry, is a lender here. I see people from Indonesia, PTSMI, also, depending where you stand, etc. So I think it's really important to understand where we sit. But as a basic starting point, it's always really important just to look at the financial model to see, okay, where the risk is. What is the right product we need to provide to finance this project? And in the case of energy, it's quite fair to say that most of the electricity that is sold in the country is in local currency. So the starting point is the revenue generated by this project is in local currency, so it should be financed in local currency. But we still see people financing those projects in dollar, and there are many reasons for why it is the case. I wanted to show an example here. It's Kenyan shilling. Sorry again for my Africanicity, my African example here, but I think we can use the same example everywhere. I use the case of Nigeria, but here I wanted to share, and I'm sure we can see it in some market, in many markets. In Kenya, do you know that the cost of electricity here, this is the Kenyan shilling, but if you zoom on, if you focus here, the cost of electricity change every month here, because of some parameters. And one of those parameters is the FX rate. I'm sure if you look at the tariff of electricity in your countries or the countries where you operate, if you look at the regulation or the policy, sometimes it's pegged because it's subsidized and so on, but sometimes there is an explicit formula. In the case of Kenya, there is what they call a foreign exchange rate fluctuation adjustment. Every month, the cost of electricity in Kenya change because of the FX. And it impacts directly the businesses, the people, the domestic client, and the big corporate. And of course, you can see kind of correlation between the cost of electricity in Kenya and the FX rate. Here you see it was a big problem for Kenya because they had some issue, but it has been solved since then. But it has a direct impact on the cost of electricity. So I think, again, as I said, I'm not an expert in that area, but if I just look at the project from a financial point of view, when you look at the financial model, as someone said in this room, that you just receive it from the sponsor, it's also good to understand where are the parameters, where are the assumptions. There are always assumptions somewhere. I'm sure if you look at it, they will tell you, we assume the currency will depreciate X% per annum. And then you can start challenging them or not. It's just to have a kind of open debate and fair to really understand who is taking the risk. To zoom in on, I think, Laurent, you have shared one slide when it comes to interest rates. You can clearly see, I didn't went too far, but I just wanted to zoom on since the last 5 years, and we all know that the cost of money is increasing in dollars terms. You can see on the left-hand side of the chart, even though the orange line is the SOFR rate. I'm sure we are all familiar with that because most of the people, when they finance project in dollars, they use SOFR as a benchmark or Euribor for euro, but you will see the same trend. But, and the blue line is the 5-year treasury bond to give you a kind of risk-free rate. But they are all quite closely similar. But one thing is the cost of financing is increasing. So of course it has a direct impact on your financial model when it comes to servicing the debt that you will take, because most of those business models are leveraged with debt. And of course, when I look at to the dollar, you can see it's also strengthening. Okay, the time when I created this graph, the dollar was at 1.1. Now it's 1.17. But as you can see, it keeps changing depending on the mood of one president. So yeah, it's great risk. You see the effects, but also the interest rates that is impacting your business. And there are solutions actually to fix that. So that's why I will be pleased to show you some examples and what we have been doing at TCX. So I think, Laurent, you also, I think we have the same source when it comes to some slides. I do recognize some of them. I think I took it from the World Bank, SMAP something, no? Just to zoom in on the financial risk. Inflation risk, I'm sure you see it everywhere. It's something, I will say, quite natural. In a lot of financial models, you will see some adjustment clauses saying that the tariff is indexed to inflation, which is quite normal. And I really wanted to focus on the four that are listed here. Interest rate risk, as I mentioned, linked to US dollar SOFR or Euribor. Every time it's increased or decreased, it creates volatility in your financial model. How to manage that? We'll see it later. And then you have the foreign exchange risk. I decided to give a bit more details here because when you talk about currency risk, it might seem very basic. Is the currency moving from A to B? In my example, remember, Naira moved to 150 to 1,500. But if you go into the details on really what is currency risk to define it properly, you can categorize several sub-risks. One of them is the fact that the currency is moving from 1 to 2. Just numbers you can see on the screen. But if you go deeper in the risk, you have also the liquidity risk. And I'm sure in the energy project, you see a lot of people saying, I'm facing a lot of risk, a lot of currency risk. Sometimes if you ask the real question, the risk they are facing is not the FX rate variation I mentioned earlier, but it's just the capacity to access dollar to service a debt or to repatriate something. And sometimes in some countries, you can just simply face a situation where there is no dollar, scarcity of dollar. And in a lot of energy projects, I can apply the same element to others project. But you keep hearing at TCI, we keep hearing people saying, I have currency risk because I cannot just buy dollars, because I have a debt in dollars from someone out of the country. So this is the foreign exchange liquidity risk really I wanted to mention here. And this sometimes came with some additional risk. You'll use again, sorry to take another African example, but Malawi. The cost, so the Malawi has a structural issue because they don't have enough dollars. And I think if you look at just the reserve of the country in terms of month of import that they can cover is below 2 months or sometimes even 1 month. It's very low. Usually IMF say 3 months is the minimum. If you can go higher, be there. So in countries where there is no dollar, you can still try to find solution to get them, but sometimes you can access dollars but at a very high rate. So you see the official rate in Malawi today is 1.734, but if you really go to the market, it's much higher than that. So this is a risk sometimes you need to crystallize somewhere. So this is the liquidity risk. And last but not least, which is a bit linked to the liquidity risk concept I just mentioned, which is the convertibility and transfer risk. Sometimes you can face scarcity, still find dollars, but you have the fixing risk. But sometimes there is simply no dollar. Because of regulation, you are not allowed as a foreign entity, for example, in some countries, to get dollars, or because you don't have the certificates needed, etc. So this creates risk, and there are institutions that can provide those kind of coverage, like MIGA. I will cover it later. We partner also with them, but this is a real risk here you can face. Or sometimes you can still convert your local currency to dollars, but you are not able to transfer them. This is the transfer risk. You see, by just saying currency risk, I divided too many sub-risks that need to be assessed properly when you do your financial modeling, but also when you try to see if the project is bankable or not. So what we will try to do is, I'm not saying that TCX can fix all those risks. We can do some. And as we live in a collaborative world, I think collaboration is key. I mentioned MIGA, I mentioned the lenders like AFD, KFW, DBS, and so on, etc. We can all work together to support those projects. Here in this slide, I just really wanted to summarize in a very simplified way three situations. You have the situation number one where we do nothing. So it means I take the loan in dollar or in euros, and I take the risk. This happens sometimes. We can see a lot of projects that can face this situation. I forget to mention that I live in Amsterdam, so TCX is based in Amsterdam, and we are there. They are very good to manage water, as you know. So I'm just thinking metaphor here. So you do nothing, but in Amsterdam they have been really good to manage that risk. And then you have the what I call here the building dikes. So you start building dikes to start to prepare to build a kind of protection here. Sorry to use a kind of too much technical word, but here I'm talking about synthetic local currency, but we'll see it later how it's work. But it's a way to start mitigating some risk I mentioned earlier, which is the currency variation risk. And then ultimately, the good situation to manage currency risk will be that third one, which is the situation you are, I will say, you have your own domestic capital market. As I said, any project that generates revenue in local currency should be financed in local currency, and the easiest way to access local currency is locally. Cash is there, banks are there, capital markets are there. But sometimes in some situation, the capital market is not developed enough. So it means you need to find fancy ways to mitigate risk. But I think for all countries, developing countries mostly that have the ambition to grow, and this is clearly the ambition of everyone, we should be there. And there are a lot of success stories like Colombia will use that as example, or India or South Africa or Vietnam to some extent, where the local capital market can finance this project. So let's now go to a bit more of details on how to mitigate risk. I don't know if there are questions, but please do not hesitate to interrupt me and ask me if there are any questions to have something more more active here. So I will go a bit more in details about the solution we at TCX we are doing with the support of our shareholders, the one I have mentioned earlier. So we offer two types of solution. And again, as I said, if you discuss with your colleagues at the treasury level, if you tell them, do you know forward? Do you know what is swaps? They will tell you yes. Maybe some of you already know. I don't know if I can maybe do a test. Who knows what is a swap? Can you raise your hand? Stefan here. Okay, 3, 4. Okay. I will say 40% of the room. Without going into too much details, those are derivative product. A derivative product is just the name you use to say we are swapping A versus B. And it is derived from something, and the something is the currency. And at TCX, in most of the case, we use cross-currency swaps to mitigate that risk. And we do that with many of you, actually. Maybe you don't know, but DBSA, KFW, in a certain way, as I said before, Agence Française de Développement, IFC, and so on, etc. So we actively engage with the treasury every day. This is the bread and butter for us with them. But maybe as a banker, you don't see it, but that are the products that are used to mitigate currency risk. And those products are available, as I said, in all developing markets. So if one day someone tell you, hey, I have this project in X, but apparently there is no market, I will say, yes, there is apparently TCX they can do. So it's kind of some self-promotion here. And the reason why we do that is not to compete. We are not a commercial bank. Maybe I should start with that just to tell you a bit more about what we do. The raison d'être, as we said here in France, is not to make money on those derivative products like a bank. You know, a bank, they buy and sell, take a margin in the middle. At TCX, we sell that product to you, and we sit on the risk. When I said we sell the risk, we buy the local currency and we sell you the dollars. When I buy the local currency, I'm not like a bank. I'm not selling it and take my margin in the middle. I sit on that risk, and with the capital that my shareholder has provided to me, I can absorb any shocks going forward. So as I said, the risk in finance, as we all know, never disappear. The moment you have a cross-border payment, it means someone is taking the risk. So what we are trying to achieve with this product is to move the risk from the off-taker through the sponsor, through the lender, and sit it at TCX and manage it on a daily basis. So we have been doing that for 18 years, and we hope to continue to do that as much as we can. So, and in terms of, just to give you a bit more details here, the tenors we can provide with cross-currency swap, we can go up to, here I mentioned 30 years, but theoretically there is no maximum limit at TCX. So if a project, that is something really important, because most of the projects within the infrastructure space or the energy sector need long-term funding. So we can still use the same swaps to structure a long-term denominated local currency loan, big, 30 years, 35, 40, 50. I think the longest we have done was 20 something in Colombia, but that is something we can support. And this is the additionality, by the way, of TCX, because no one in the market can do that. The moment that a bank can do that, we don't play a role because we have no value added. Our value is really to step in when there is no one else. So this is our additionality, to use a jargon of ADFI. Last element, which is linked to the interest rate risk, as I said, the product can be used to mitigate currency risk, but also interest rate risk. So the swap can be done versus SOFR. Here I used, I don't know where I've put it, sorry, here, fixed or floating. So for all the currencies, you can structure a local currency denominated loan with an interest rate at a fixed rate. So you bring predictability to the debt service of that project on a local currency basis. So you kill, if I may use this metaphor, two birds with one stone. And of course, in some cases, there are some projects that need floating interest rate, but most of the cases they need fixed. And sorry to send you this diagram, which is actually a simplified one in one slide. I don't have all the skills of Laurent making all the noises, displaying his slide, but please be with me. I will try to walk you through that slide, and I decided just to put numbers just to follow from 1 to 10. So as you all know, when we structure a project, you always have those stakeholders, but again, this is the simplified version, again. But just to have the idea here, you have the project company or the developer, you name it, and they sponsor, they provide equity, let's say 20, and the remaining 80 is debt coming from DFIs, okay? And assuming that you want to structure a loan or a project or a financial model in local currency, it means this needs to come in local currency terms. This needs to also come in local currency. As I said, each project that generates revenue in local currency should be financed in local currency. But at the same time, you have mentioned something, Laurent, which is really important here. In many projects, you still need dollars and euros because most of the capex need to be settled in euros and dollars. So you create an additional point here. So as a developer, you say, okay, the best product for me is to borrow or to get funding in local currency, but at the same time, you need local currency. Hard currency. And this is why I started with this distinction before to split what are the different risks. Here is a liquidity issue or a liquidity situation. Why do I need dollars and euros? Because I need to pay my importers somewhere out of my country of operation, and they will use euro or dollars. That's the reality here. So with this type of structure, again, you can kill, sorry to use that brute metaphor, I'm a big fan of birds, two birds with one stone. So you still receive dollars and euros, because most of the DFIs, they use dollars, mostly the international dollars or euros. But from that day of disbursement, you fix the FX rate that will be applicable for the entire period of the investment. So step number 1, 20 equity, 80 debt in hard currency. You have your hard currency, You can import some of the capex you need in dollars, you pay your supplier and so on. And if you have a portion of the projects that still need local currency, you can still sell those dollars or euros and buy local currency to pay the capex that are denominated in local currency. So it's a kind of good situation. You can mix different flavors, okay? 1, 2, fine. Step number 3, okay, it's a very quick one. I receive the money, my plant is here. You see, it's a simplified version one. So I start producing energy and I deliver to my off-taker. And the real value added of that structure for the off-taker perspective, again, as I said, it's always about perspective where you sit. If I'm the off-taker, let's say the large utility scale operating in the country, a public one, I would love to have a local currency denominated PPA. Not like in the Kenyan situation where every time I need to pay the electricity I'm using, I need to adjust due to the FX rate movement. Having a local currency PPA is unfortunately a luxury, is not a situation that is applicable everywhere. In many countries, most of the financial model will require the PPA to be in somewhere indexed to the dollar. And if you go into the details, you open the PPA agreement, I'm sure you'll find somewhere, even though sometimes it is denominated in local currency, you will see there are a kind of adjustment somewhere. So the whole idea is to shift from that PPA indexed or in dollar to a PPA indexed or linked to the local currency. And the value of the off-taker again here is to have predictability when it comes to paying the cost of electricity. You use the leveraged cost of energy. Most of them are usually in euros, in dollars. But what if LCO in local currency? You see, you can have this kind of discussion with the off-taker. And then imagine that it is okay. The local currency is in local, the PPA is in local currency. You are step number 4. You have someone who is happy here, the off-taker. I don't anymore face any currency risk going forward. I can pay the same tariff in for my electricity, except maybe some inflation adjustment. But if you stop here at level 4, so it means the risk is here and here. As I said, the risk never disappears. It's just shifting from pocket 1 to pocket B. So they've been able to shift the risk to those people. Now it's their problem to fix it. So this is where actually we at TCX, we stand here and say, hey, we can help you. In the case of the DFI, I will say step number, you follow me, I'm 1, 2, 3, 4. Step number 5 is when actually the project starts generating revenue in local currency, they need to service the debt in local currency again, as I said, step number 5. So the DFI will start receiving local currency flows every 6 months, I would say, or every year, depending on the structure you decided. And at the same time, once they receive the local currency, they will send it to someone, let's say, for example, TCX. And we will give them hard currency. So for them, at the end of the day, it's fine. They provided a loan in local currency. So they provided hard currency liquidity, but denominated in local currency. And at the end of the day, they mitigate the risk. So for them, it's okay. 80% of the financing is hedged. And then you have the sponsor. It's now their problem. What do I need to do? Same rationale. Step number 8. Usually they receive dividend and other cash flows for operating and maintenance extra if they do everything there. Same here. They can use the swaps or the forward I mentioned earlier. So with this structure, a simplified again version, the currency risk have moved from the off-taker through the project company, through the sponsor, and end up here. As I said, it never disappears. It's always shifting. So that is the way we have found at TCX to support financing to the sector without putting currency risk on the project or on the off-taker. But in our balance sheet, I will say at the end of the day, the risk sits in the balance sheet of our shareholders. You are always around because you provided the capital, remember, at the beginning. I don't know if there are some questions to this slide, but if there are any, please, we can have a discussion later on or now if you want, or I will let you digest that one. So here, just to summarize what I described here, the key benefit and consideration when it comes to that structure. The first one, as I said, is the tenor. Long-term funding need to finance long-term asset, and in this case, it's purely applicable, 25, 30 years, etc. Fixed interest rate to manage interest rate risk, as I said, and provide more predictability to the financial model. The liquidity issue I have mentioned, we still need sometimes dollar or euros to pay EPC contractor and so on, or to pay some part of the capex. It's fixed. And the external debt service and the PPA are fully denominated in local currency. This is the way you actually shift the progress, the risk from the off-taker and the project developer. And as I said, at the end, the whole idea is to mitigate all the currency risk for all the parties. So that's the structure. And in the structure I have mentioned, as I said, at TCX, we don't take all the risk. We have been created to take FX variation risk. You still have that convertibility and transfer risk, which is still prevailing here, which is sometimes also a really important one. But I will say the same transfer and convertibility risk, if you just forget for a moment local currency, because I talk too much about that because it's our bread and butter, but if I remain in a, let's say, dollar financing, you still have that risk. So it's a risk that needs to be addressed, if it is local currency or not. So this is why just wanted to shed light on some initiative we have been doing with MIGA. As you all know, MIGA is part of the World Bank Group. They are an insurance company, entity, and one of the products they offer is the transfer and conversion risk. So we had an idea, which is actually quite straightforward. What if you combine all things? So TCX, we take FX variation risk, this volatility, and MIGA, you guys, you take the transfer and conversion risk. So we combine the two, and then we can have a very nice project, well designed, and so on. I'm not talking about pricing yet, because we need to put it somewhere. But we started to discuss with them. It is not finalized yet, but we have been doing some good work. It's a kind of invitation to all of you. If you have any projects that MIGA can be and TCX can support, we'll be more than happy to explore. It's a pilot. It's not tested yet. So just to give you some advantages. And actually, the solution we are trying to offer is the one in green, where again, as I said, we combine our strengths. And as you can see, in terms of risk allocation, the credit risk still remain at the lender. Transfer recovery risk can be mitigated by MIGA here. The fixing risk, it's a joint offering, as I mentioned earlier, and we take the currencies. So I would say the green bar here, the last one, is the one where we can mitigate a lot of currency and interest rate risk. But again, the product is not ready yet, but we already had multiple presentations with the VPs of EBIGA and TCX and so on to see what we can do to support financing in this sector. This is just a numerical example, but I will let you read it later on to describe how it's worked. But I think the slide will be shared right after, so people can go into the details to see how it's work. But as I said, just maybe to give you some input here, this is the variation risk. You see the currency moving from 140 to now 157. So we take that risk at TCX. This is our bread and butter. And then you have actually the market, where really I can buy dollars. Is not at the official rate of 157. It's let's say 10% more, 172. So it means someone is taking that risk. Of course, MIGA as an insurance, they always have a threshold. In this case, it's 5%. They say, okay, I'm happy to cover that risk and leave that risk just to align interests of different parties. But we can structure it in different ways. So what I'm trying to really to explain here is there are multiple risks that are associated with currency that could be mitigated in various flavors. So the last part of my presentation, as I said earlier, as a teasing, was an announcement that we have done last week in Sevilla, where our CEO and his staff were present, and with the support of the European Commission, but also one of our shareholders, KfW, that has started a pilot project with us. We have been able to provide, let's say, concessional hedging solution. I didn't touch about pricing because we can have a long debate when it comes to pricing. It always takes a lot of debates because what I'm saying here is, it seems to be a nice story what I'm saying here. I have solution for everything, but sometimes there are also pros and cons. And of course, there is always a price for everything in business, I would say. So, and one of the critiques, and here I'm really modest to say that we receive so often is, okay, fine, the solution is great, but what is the cost? I can mitigate all the risk, but if I end up with a project that is having an interest rate of 25%, which is the case in Malawi, or 50%, 50, it used to be the case in Nigeria or Sri Lanka before the crisis. I cannot finance a project at that rate. It's not just, I cannot swallow that. If I put it in my financial model, it's not working. But the need for local currency is still there. So the purpose of that facility was very basic. It was to, I use the term in the past, but it will also come in the future, to subsidize actually the cost of hedging. If I use my example of Malawi, I said my cost of hedging is 20% per annum. The project is not bankable. If I put it at 10, it becomes bankable, so I need 10% per annum of discount or subsidy. Where can I find it? So with the support of the European Commission, we have been able to just lower the cost of funding in local currency terms to make impactful project real and make them happen at the end of the day. So we started with a pilot project during the 2 last years, where we have been able to do 120 million euros of transaction in local currency. It could be small, it depends on where you stand, but for us it was relatively small, but again it was a pilot. And last week we announced that we're going to scale up that facility to 2 billion of euros. So it means with this facility, and specifically in collaboration with FIX and IDFC, this is correct, all DFIs, MDBs, will be able to structure transaction, the one I showed you earlier, in a concessional terms to make project impactful at a concessional or affordable rate that will make the business model works. So we have 5 years in front of us to start generating pipeline of projects. Maybe some of them are already mature, etc. But the whole idea is to support those projects across a list of close to 90 countries. Mostly, you will see in this map, and you will say, hey, where is Latin America? Unfortunately, Latin America is not part of that. I think there are some people from Latam, I see Cabe somewhere. So it's mostly designed to Asia, CIS, and some countries in Africa. Actually, there is one country in Latam, which is Haiti, that can benefit of that. Don't ask me why, but there are some reasons and guidelines we need to follow there from other parties. But the whole idea is to support projects across sectors, and financing clean energy is one of them in those countries at a much lower rate. So tomorrow, my transaction in Malawi, instead of being at 30%, I can put it at 10, and then we have the deal. And it is open to both private, but also public. So it means concretely if the borrowing need to be done at the sovereign level because of the lack of creditworthiness of the utility, it could be also applicable there. It can be also be for the benefit of an IPP within the private sector. So it's really a solution to currency risk, but also a solution, and most importantly, to the cost of financing that we keep seeing moving up and then up for the last years. So I will stop here. I think I finished pretty on time. I still have 10 minutes for any question or reaction and comment.